Hello traders, welcome to our new video. We are dedicated to give the best education and encourage you as a trader through a comprehensive explanation of the forex trading topic. So, today in this first video on this segment, we will discuss about fundamental analysis, one of the basic analysis in forex trading. Because this topic is basic knowledge, make sure you don't skip any part. Let's dig in. First, let me explain what fundamental analysis is. Fundamental analysis is a method used in forex trading to evaluate the intrinsic value of a currency based on economic, political, and social factors that impact its supply and demand. Traders who employ fundamental analysis believe that these factors play a crucial role in determining the long-term trends and value of currencies. Fundamental analysis involves analyzing various indicators and data to assess the overall health of an economy and make predictions about future currency movements. More precisely, there are 5 main topics to pay attention to in fundamental analysis: geopolitical events, market sentiments, economic indicators, news events, and central bank policies. Let's break down this topic into more comprehensive discussion, shall we? The first topic we'll talk about is geopolitical events. Analyzing geopolitical factors is an essential aspect of fundamental analysis in forex trading. Geopolitical events and developments can significantly impact currency values as they reflect changes in political stability, international relations, and global economic dynamics. Yep, this is our consequence when we jump into forex trading. We should be obedient towards politics even we don't like it. What an irony, right? Okay, let's move on. Here are some key considerations when analyzing geopolitical factors in fundamental analysis for forex trading. First is political stability. Political stability or instability in a country can have a profound effect on its currency. A stable political environment is generally associated with investor confidence and a strong currency. Conversely, political turmoil, civil unrest, or regime changes can lead to currency volatility and depreciation. Second, government policies. Government policies, including fiscal policies and regulatory frameworks, can influence currency values. Traders assess the impact of policies such as taxation, public spending, trade agreements, and economic reforms to gauge the long-term prospect of currency. Third, geopolitical tensions. Geopolitical tensions between countries or regions can create uncertainty in the forex market. Events like wars, conflicts, sanctions, or trade disputes can cause currency fluctuation as they disrupt trade flows, impact investor sentiment, and raise concern about economic stability. Fourth, economic interdependence. Geopolitical factors consider the interconnection between economies. Global trade relationships, alliance, and regional economic integration affect currency values. Traders analyze the potential impact of geopolitical events on trade volume, cross-border investment, and currency exchange rate. The fifth, safe haven status. Certain currencies such as the US dollar, Swiss franc, or Japanese yen are considered safe haven currencies. During times of geopolitical uncertainty or market turbulence, investors tend to seek refuge in these currencies, leading to appreciation. Traders monitor geopolitical developments to identify shifts in safe haven preference and their impact on currency markets. 6. Central bank responses. Geopolitical events can prompt central banks to adjust their monetary policies in response to changing economic conditions. Traders analyze the statements, speeches, and action of central bank officials to understand how geopolitical factors influence their policy decisions, including interest rate changes and currency interventions. The last consideration is economic sanctions and trade policies. The imposition of economic sanctions or changes in trade policies can have significant consequences for currency values. Traders consider the potential impact of sanctions, embargo, or tariff disputes on international trade and economic stability, which in turn affect currency movement. Pretty much, isn't it? But it's just some considerations. You don't have to analyze all of it. Just pick what you need for your trade. Let me give you a practical example of this. When the US launched some missiles against Syria during Donald Trump era, the US dollars became more volatile than usual. Some people got their profit and the others got their losses. Okay, hopefully you can understand clearly about this topic. Let's move on to the next topic. On this second topic, we will discuss market sentiment. What? Market sentiment? What's that mean? Is the market so emotional? Well, maybe that's right. When it comes to analyzing market sentiment for fundamental analysis in forex trading, you're essentially trying to gauge the overall mood and outlook of traders towards a particular currency pair. Yes, Wood. This involves understanding how people feel about the economic, political, and social factors that influence currency movement. To do this, you can look at various indicators and factors. Economic data such as GDP growth, inflation rates, and employment figures can provide insight into the overall health of an economic and impact market sentiment. Positive data may lead to bullish sentiment, while negative data can result in bearish sentiment. News events and geopolitical developments also play a crucial role in shaping market sentiment. Major announcements such as interest rate decisions, trade agreements, or political instability can quickly shift sentiment and impact currency prices. Moreover, monitoring social media platforms, financial news websites, and forums can give you a sense of how traders and investors are discussing and perceiving the market. Tracking sentiment indicators like the CBOE Volatile Index can provide clues about market fear and risk appetite. Additionally, paying attention to central bank communications, speeches, press releases can be essential in understanding the sentiment of policymakers and their potential impact on currency market. Let me give you an example of this. When the FOMC raised the interest rates for 25 bps, the US dollar followed the trends. It raised up along with the raising of interest rates. Most of traders bought the USDT at the time. So it proves the sentiment of the market will impact your trade. Okay, let's move on again. Have you ever heard about gross domestic product or GDP, customer price index or CPI, and unemployment rate? Those things are called economic indicators. And yes, you can analyze them for your fundamental analysis. Economic indicators are a key part of fundamental analysis, and they can be used to predict future currency movements. As I mentioned it before, let's dig deeper into economic indicators. First, gross domestic product. Gross domestic product is the total size of the economy. It's like the weight of a person. A higher GDP means a bigger economy, and a lower GDP means smaller economy. So, how can you analyze this for your trade? Here's an example. If the GDP of a country is growing, it's likely that the currency of that country will appreciate in value. This is because a growing economy means more businesses are doing well, which means more people are employed and spending money. This increased demand for goods and services will drive up prices, which will make the currency more valuable. Second is the unemployment rate. The unemployment rate is the percentage of people who are looking for a job but cannot find one. It's like the body fat percentage of a person. A higher unemployment rate means more people are struggling to find work. And the lower unemployment rate means people are employed. This is an example of how you analyze it for your trade. If the unemployment rate is rising, it's likely that the currency of that country will depreciate in value. This is because a rising unemployment rate means that there are more people who are struggling to find work, which means there is a less demand for goods and services. This decreased demand will drive down price, which will make the currency less valuable. Next is the Consumer Price Index or CPI. The Consumer Price Index is a measure of how much prices have changed over time. It's like the scale you use to weigh yourself. A higher CPI means prices have gone up, and the lower CPI means prices have gone down. Here's an example. If the CPI is higher than expected, it could signal that inflation is rising, which could lead to a sell-off in the currency. If the CPI is lower than expected, it could be a signal that inflation is easing, which could lead to a rally in the currency. Do you get it? The first is Purchasing Managers Index or PMI. PMI is a measure of business activity. It's like the heart rate of an economy. A higher PMI means businesses are doing well, and a lower PMI businesses are struggling. Let's say a higher PMI than expected can lead to a rally in the currency of the country in measure, as investors will be confident that the economy is doing well. A lower PMI than expected can lead to a sell-off in the currency of the country being measured, as investors will be concerned that the economy is not doing as well as it thought. The last is the mighty interest rates. Interest rates are the cost of borrowing money. They're like the price of a product. A higher interest rate means it's more expensive to borrow money, and a lower interest rate means it's cheaper to borrow money. A higher interest rate than expected can lead to a sell-off in the currency of the country that being measured, as investors will be concerned about the impact of higher borrowing costs on the economy. A lower interest rate than expected can lead to a rally in the currency of the country that being measured, as investors will be relieved that borrowing costs are not as high as they feared. Alright, I think that's enough about the economic indicators. Let's move forward to the next item. The next thing you should analyze for your fundamental analysis is news events. News events are a key part of a fundamental analysis, and they can be used to predict future currency movements. So, what are the important things of news events for fundamental analysis? Here are some of them. Number 1. News events are like breaking news for the market. They can cause big swings in currency prices, just like we mentioned it earlier. Number 2. Traders need to stay up to date on news events to make informed trading decisions. Number 3. Some news events are more important than others. Major news events such as interest rate decisions or elections can have a significant impact on currency prices. And the last is number 4. Other news events such as company earning reports or natural disasters can also affect currency prices, but to a lesser extent. When conducting a fundamental analysis of news event, it is critical to examine the following factors. The news event substance. To do this, you can answer these questions. What is the significance of the news event? What does this have to do with the economy? The second is the news event's timelines. You can answer these questions. When did the news event take place? Is this new or old news? The third thing is the market's reaction. What was the market's reaction to the news? Did currency prices rise or fall? By taking these elements into account, traders can gain a better knowledge of how news events affect currency values and make more informed trading decisions. To get more clear, let me explain some examples of how news events can affect currency prices. When the central bank boosts interest rates, the value of the currency may rise. When the country's economy is doing well, the value of its currency may rise. When the country's government is unstable, the value of its currency may plummet. Is that clear? If so, let's move on to the final item of fundamental analysis, the central bank policies. Central bank policies are also an important component of fundamental analysis and can be used to forecast future currency movements. Let me describe it more precisely. Central bank policies act like market traffic lights. They can indicate when it's time to buy or sell currencies. So, traders need to pay attention to central bank policies to make informed trading decisions. Some monetary policies of central bank are more important than others. Interest rate changes and quantitative easing by central banks can have a considerable impact on currency market. Other central banks' measures, such as open market operation or foreign exchange intervention, can have a minor impact on the currency values. Are we clear about the description? Okay, let's move on. Just like previous item before, you should consider some things. The first thing you should consider is the central bank's objectives. What are the objectives of the central bank? Are they attempting to keep inflation under control, boost economic growth, or ensure financial stability? Answer these questions so you can analyze issue. The second thing is the tools available to the central bank. What instruments does the central bank have? It has the authority to raise interest rates, print money, and intervene in the foreign currency markets. The last thing, the market's expectation. What do market players anticipate the central bank will do? Are they anticipating a rate increase, a rate cut, or no change? Just answer these questions so you can analyze your fundamentals more clearly. Now, to get easier to understand, I'll give some examples how central bank policies can affect currency prices. If a central bank pushes interest rate, the value of the currency may rise. And if a central bank reduces interest rates, the value of the currency may plummet. If a central bank intervenes in the foreign exchange market, it could cause the value of the currency to rise or fall. Well, I think that's all of it for fundamental analysis. Hopefully, all of you understand with my explanation. And see you in the next video. Bye-bye.